For months, Bitcoin looked broken. It had fallen from its 2025 highs. Investors were losing interest. The excitement was gone. And then, Bitcoin suddenly came back to life. In just days, the price ripped toward $80,000, recording one of its strongest weekly moves in years. On August 21st, Bitcoin briefly climbed above $79,000, while U.S. spot Bitcoin ETFs were attracting hundreds of millions of dollars in fresh capital. The Economic Times. But here's what makes this rally interesting. It wasn't simply a story about people suddenly becoming bullish on Bitcoin. Something much bigger was happening underneath the surface. Money was moving. Liquidity was changing. Wall Street was buying. Short sellers were getting trapped. And investors were once again asking the same question: what if Bitcoin isn't finished? Because the biggest rallies rarely begin when everyone is excited. They begin when almost nobody is paying attention. And this rally may be telling us something important about where money is flowing next. Level 1. The rally started where nobody was looking. To understand the Bitcoin rally, we have to start with something that sounds incredibly boring: government debt. On August 20th, the U.S. Treasury announced that it would double its buyback program for longer-dated Treasury securities, increasing the planned amount from roughly $2 billion to $4 billion. 21 shares. At first glance, this has almost nothing to do with Bitcoin, but markets don't work in isolated boxes. When financial conditions become easier, liquidity can find its way into assets that investors consider scarce or risky. And Bitcoin happens to be one of the scarcest assets on Earth. There will only ever be 21 million Bitcoin. No central bank can simply print another 10 million. No government can vote to double the supply overnight. That scarcity becomes particularly interesting when investors begin worrying about currencies losing purchasing power. And that is exactly what started happening. The dollar weakened. Long-term bond markets were under pressure. The U.S. national debt had crossed $40 trillion. Gold surged, and Bitcoin started moving with it. This is sometimes called the debasement trade. The idea is simple. If investors believe the value of traditional money could decline over time, they look for assets that cannot be created as easily. Gold, real estate, and increasingly, Bitcoin. The surprising part? The Treasury announcement didn't create Bitcoin's demand. It may have simply revealed demand that was already waiting underneath the market. Level 2. Wall Street was already buying. Here's where the story gets even more interesting. While retail investors were debating whether Bitcoin was dead, institutional money was quietly returning. U.S. spot Bitcoin ETFs had experienced heavy outflows during May and June. Then the trend reversed. By the week of August 17th, Bitcoin ETFs were recording enormous inflows. On August 20th alone, U.S. spot Bitcoin ETFs attracted more than $517 million. And by August 21st, weekly inflows had accelerated even further. The block. By Friday, 5 consecutive positive sessions had brought approximately $1.92 billion into U.S. spot Bitcoin ETFs. Combined ETF assets reached roughly $96 billion. Bitcoin news. Think about what that means. People weren't necessarily opening crypto wallets. They weren't necessarily learning how private keys work. They weren't spending hours researching obscure exchanges. They were simply buying Bitcoin exposure through a familiar financial product. And this changes the game, because Bitcoin used to require people to enter the crypto world. Now, traditional finance can bring Bitcoin into its own world. That distinction matters. A pension manager doesn't need to become a crypto expert. An investment advisor doesn't need to explain cold storage to a client. A wealthy investor doesn't need to directly manage a wallet. They can simply allocate capital through a regulated investment vehicle. The technology hasn't changed, but the distribution system has. And sometimes, distribution is what turns an asset from a niche investment into a mainstream financial product. Level 3. Then the shorts got trapped. But institutional buying alone doesn't explain how quickly Bitcoin exploded. For that, we need to understand something much more dangerous. Leverage. When traders believe an asset will fall, they can short it. They borrow an asset, sell it, and hope to buy it back later at a lower price. If Bitcoin falls, they profit. But if Bitcoin rises, the trade starts working against them. And eventually, some traders are forced to close their positions. They have to buy Bitcoin back, which pushes Bitcoin even higher. which forces more short sellers to close, which creates more buying. And suddenly, a rally becomes a feedback loop. According to market analysis, more than $1.5 billion in Bitcoin short positions were liquidated during the recent move, with roughly $700 million reportedly cleared within a single minute. 21 shares. This is why Bitcoin rallies can look completely irrational. The price isn't always rising because millions of new investors suddenly decided Bitcoin was worth more. Sometimes, the market is forcing sellers to become buyers. That's the hidden engine. And it explains why a move that starts slowly can suddenly become explosive. But there's another reason this rally became possible. Bitcoin's market structure has changed. Level 4. Bitcoin isn't the same asset. It was 5 years ago. Go back to the early Bitcoin years. Bitcoin was mostly a strange internet experiment. Then it became a speculative asset. Then a global trading market. Then corporations started putting it on their balance sheets. And eventually, Wall Street built financial products around it. That transition is enormous. The introduction of U.S. spot Bitcoin ETFs fundamentally changed how traditional investors could access Bitcoin. Instead of asking, "How do I safely buy and store Bitcoin?" the conversation became, "How much Bitcoin exposure should my portfolio have?" That's a completely different question, and it changes investor psychology. A traditional portfolio might contain stocks, bonds, gold, real estate, cash, and now, Bitcoin. The asset that once existed outside the financial system is increasingly being packaged inside the financial system. That's why companies such as BlackRock matter so much. The investment giant's Bitcoin ETF has become one of the largest channels for institutional Bitcoin demand. And during the latest rebound, BlackRock's IBIT accounted for a significant portion of the fresh inflows. The block. This creates a fascinating contradiction. Bitcoin was designed partly as an alternative to traditional finance. Yet traditional finance may now be one of the biggest forces pushing Bitcoin forward. And that brings us to the most important lesson. Level 5. The rally was really about money. People often look at Bitcoin charts and ask, why did Bitcoin go up? But that's usually the wrong question. The better question is, why did people suddenly want to own Bitcoin at a higher price? Because price is simply the meeting point between supply and demand. Bitcoin's supply is structurally limited, so when demand changes, the price can move violently. And this time, several forces arrived together. ETF inflows, institutional demand, short liquidations, regulatory optimism, a weaker dollar, changing expectations around interest rates and liquidity, and growing concerns about government debt. Each factor matters, but together they can become much more powerful. That's why the rally caught so many people off guard. They were watching Bitcoin, but they weren't watching the system around Bitcoin. And this is one of the most important lessons for anyone trying to build wealth. The biggest opportunities rarely exist in one chart. They exist at the intersection of multiple trends: technology, politics, liquidity, psychology, business, and human behavior. Bitcoin is simply where all of those forces are colliding right now. But there is a warning, because a rally can be real and still end badly. Bitcoin remains extremely volatile. A powerful move upward doesn't guarantee that the next move will be higher. In fact, explosive rallies often create the conditions for explosive corrections. Investors who buy simply because the price is rising can become the liquidity for someone who bought much earlier. That's why the real question isn't, will Bitcoin reach $100,000? Nobody knows. The better question is, what would have to remain true for Bitcoin to keep attracting capital? If ETF demand continues, if institutional allocation grows, if liquidity remains supportive, if regulatory uncertainty keeps falling, and if investors continue treating Bitcoin as a scarce asset in a world of expanding debt, then the long-term story becomes much more interesting. But if those forces disappear, the rally can disappear with them. Conclusion: the people who saw it coming weren't guessing the price. The most fascinating part of this Bitcoin rally isn't the number on the screen. It's what happened before the number changed. While headlines were focused on Bitcoin's weakness, money was quietly moving. While retail investors were losing interest, institutional products were accumulating demand. While traders were betting against Bitcoin, the market was preparing to punish those bets. And when liquidity, demand, and psychology finally collided, Bitcoin moved fast. That's the real lesson. Markets don't reward people simply for predicting prices. They reward people who understand why capital moves. Because the next great opportunity might not look exciting at first. It might look boring. A government policy, a change in interest rates, a new financial product, a shift in regulation, a quiet change in investor behavior. Then suddenly, the market notices, and by the time everyone is talking about it, the biggest move may already be behind them. Bitcoin has reminded the world of something markets have always taught us. Fortunes are rarely made when everyone agrees. They're made by understanding the forces changing underneath the surface, before everyone else sees them. And perhaps the most important question isn't whether this is the beginning of Bitcoin's next great rally. It's whether you're watching the price, or whether you're finally watching the money behind it.